Could you share with the audience what are some of the less notable changes that we should be paying attention to?
I'll start that out, Chuck. So I think you guys heard, especially when elections were going on, about no tax on tips, no tax on overtime. So technically that is true. So there are tips that are not taxable. It's phase out again, like we've spoken to earlier. Those up to $25,000 of tips for both married filing joint and single up, but then it phases down at $300,000 and $150,000 single. Overtime as well. That's $12,500 for single, $25,000 for married filing joint. Now, the thing is with employers and reporting, that's another nuance. The employers really don't know how to report that on the W-2. So there's not a whole lot of guidance for 25, except for they're going to change it to W-2 in 26. So there you go. In 26, we know what to do. 25, what the guidance really that we've interpreted is that you put it in box 14 and with an explanation of what that is. It's an informational so that you know when the tax return is being prepared, that they know what to do with those amounts.
So there's a lot of these little ones. I'm going to touch on one, auto loan interest. So they've added up to $10,000 that you can deduct if you've purchased a vehicle that was assembled in the U.S. Again, there's a phase out. If your income's over 200 joint or 100 single, you don't get this deduction. But for those under those thresholds, if you're thinking of buying or leasing, this may impact knowing that you can deduct the interest if you buy and you don't get any deduction if you lease.
Now, there's a few others too, like the child tax credit is permanent. That's a penciled P. But yeah, it's actually increased from 2024 up to 2,200 in 2025. And that's phases out at 200,000 single, 400,000 at married filing joint. Also enhanced the adoption tax credit. You can get actually a $5,000 refundable part of that credit. Normally that's not below the line, what we call it. It usually is above the line, which is new. Dependent care and FSA exclusion increased from $5,000 to $7,500. One of the bigger pieces of that, though, is that they increased the eligible expenses that you can apply for to it from 35 to 50. I'm sorry, was that right? Yes, 35 to 50%. See, I have notes. I just want to make sure I tell you everything accurately. So the other big thing, though, is energy credits. A lot of the energy credits are being eliminated. Phase outs happening for the clean vehicle credits. They expired 9/30. Residential home improvement credits expired this 12/31. And then the commercial clean vehicle, which is expiring June 30th of 26.
I'll throw one more out there for the crowd. So I don't know if we have any gamblers in the room. Probably not, but you probably have a friend that likes to gamble. So pass this along to them. The IRS has changed the rules related to the wash of that. So no longer can you wash out 100% of your winnings by your losses. They have a 90% rule now where you can only offset 90% of your winnings. So regardless of how much you lose, like you could win 10,000 and lose 25,000, you're still reporting tax on 1,000 because 90% of your losses can go against your earnings, and which means basically and again, pass this along to your friends. If there's any earnings at all, if you win anything, you have reportable income. It doesn't matter how much you lose. At least 10% of the earnings for all of the gamblers now are supposed to be reported on the tax return. I've asked a lot of people over the years, I understand you like to place a few bets, and the response is always, I'm not putting anything down, I always lose more than I win. Well, apparently Congress got wind of that particular attitude. They said it's no longer possible for you to lose more than you win as it relates to the tax reporting, because at least 10% of the winnings now belong on the tax return.